November 2025. A single biotech ticker, GUTS, has once again crawled back into Wall Street's collective consciousness. Fractyl Health Inc., once a darling of the metabolic revolution, now trades near $1 a share. The headlines call it forgotten. The analysts call it undervalued. Some call it a miracle waiting to happen. And that contradiction, hope clashing with history, is precisely why we're talking about it tonight. For those watching this as a shorts clip, you can find the full uninterrupted version through the link below, where every detail and market perspective unfolds without pause. And stay until the end, because our full technical forecast and trading framework are coming later in this episode, with price targets grounded in both chart structure and narrative risk. To understand Fractyl Health's strange resilience, you have to go back to 2010, to Burlington, Massachusetts, and to a single defiant hypothesis. Its founder, Dr. Harth Rajagopalan, a Harvard-trained cardiologist, asked a question no one else in endocrinology was asking. What if type 2 diabetes doesn't start in the pancreas at all? Conventional wisdom, supported by nearly a century of medical consensus, holds that the disease stems from insufficient insulin production. Rajagopalan saw something different. He believed the real trigger lay higher in the digestive tract, in the duodenum, where years of processed sugar and fat erode mucosal lining. That erosion, he argued, scrambles the gut's hormonal feedback loop and sends false metabolic signals to the pancreas. His answer was not another drug, but a physical reset. From that vision came Revita, a minimally invasive endoscopic procedure designed to resurface the duodenal lining, essentially burning away damaged mucosa and allowing new, healthy tissue to regenerate. It's not a metaphor. The process uses controlled thermal ablation. In a field where treatment usually means lifelong medication, Revita promised a one-time mechanical correction. That departure from pharmacologic orthodoxy made Fractyl an outlier from the start. Years later, the company doubled down with Rejuva, a gene therapy platform using adeno-associated virus, AAV, vectors to reprogram pancreatic beta cells and restore durable insulin sensitivity. Most biotech firms pick a single lane, device innovation or genetic therapy, because the regulatory and operational demands differ completely. Fractyl tried to drive both at once, an uncommon and deeply ambitious choice that made it both visionary and volatile. The boldness of that ambition culminated on February 2nd, 2024, when Fractyl went public on NASDAQ at $15 a share. For a pre-commercial biotech with early-stage data, that pricing was exceptional. Normally, similar listings price between $6 and $10, reflecting uncertainty around clinical validation. The premium signaled extraordinary investor faith, but faith is fragile. Within months, quarterly filings showed barely $90,000 in revenue and a net loss of roughly $70 million, a year-over-year deterioration of about 25%. In a typical post-IPO scenario, companies show flat or slightly improved net losses as IPO proceeds cushion expenses. Fractyl's accelerating deficit broke that pattern. The market interpreted it as a breakdown in financial discipline. The stock collapsed below $3, a 70% fall that stripped away the halo of innovation and replaced it with skepticism. Then came 2025, and with it, the test of endurance. Early in the year, Fractyl secured FDA investigational device exemption approvals for two pivotal trials, Remain-1 and Revitalize-2. Remain-1 would assess whether Revita could help patients maintain weight loss after discontinuing GLP-1 receptor agonists, drugs like tirzepatide and semaglutide that had redefined obesity care. In the standard pattern, when a biotech announces such IDE approvals, share prices spike because regulatory clearance implies safety validation and trial readiness. But guts defied that norm. Market didn't move. No volume surge, no relief rally. This anomaly revealed a psychological shift. Investors had stopped responding to data. For a development stage biotech, that's as dangerous as a clinical setback. It means the story has lost credibility. By August 2025, financial stress forced the company's hand. It raised roughly $20 million through a new stock offering. In itself, that's not unusual for a small-cap biotech. Secondary offerings are common between trial phases. What came next was not. Just 1 month later, Fractyl raised another $60 million, again at $1 per share, the same price as first. Two back-to-back capital raises at identical discounted levels are virtually unheard of. Normally, companies space offerings by several quarters to avoid eroding investor confidence and to let the market absorb the dilution. Fractyl's decision suggested urgency bordering on desperation. Yet it also implied something else. Management believed a major catalyst was imminent and worth funding at any cost. That dual signal, risk and conviction, split investor sentiment. Was this fiscal recklessness or strategic endurance? In September 2025, the answer began to take shape. Interim data from the Remain-1 trial revealed a startling result. Patients who stopped GLP-1 drugs maintained their weight. To grasp how unusual that is, consider the pharmacodynamics of GLP-1 agonists. These drugs suppress appetite and slow gastric emptying, but once discontinued, patients typically regain two-thirds of lost weight within months. That's the established rebound curve. Revita's data broke that curve. It suggested that resurfacing the duodenal lining had rewired the metabolic response itself. If validated, it would mean a one-time procedure could preserve the metabolic benefits of drug therapy without ongoing pharmacologic dependence, a potential paradigm shift in chronic disease management. The finding re-energized the story, if not yet the balance sheet. The technical indicators began to reflect that shift. Volume spiked, suggesting accumulation. The relative strength index moved to the mid-40s, signaling a transition from oversold to neutral momentum. The MEMAC-D line flattened near zero, hinting that downward momentum had exhausted itself. The average directional index hovered around 28, a level consistent with an emerging trend but not yet full confirmation. These are not random numbers, they tell a behavioral story. After months of capitulation, buyers were returning quietly, testing conviction against memory. By late 2025, Fractyl's identity had evolved. Revita was no longer marketed as a radical gut reset device, but as a non-pharmacologic complement to GLP-1 therapies, offering a bridge between drug-based intervention and metabolic autonomy. The Rejuva gene therapy, still pre-IND, represented the moonshot, the idea that the pancreas itself could be genetically retrained. Together, these platforms placed Fractyl at a rare intersection, near-term procedural adoption with long-term genomic potential. In an industry defined by specialization, that breadth was extraordinary and polarizing. It required investors to think in two timeframes at once. Financially, the company remained under strain. After the September financing, Fractyl had raised roughly $80 million total, extending its cash runway through 2027. That's survival capital, not growth capital. Normally, such back-to-back dilution would precede a merger or licensing deal to stabilize funding. Fractyl instead chose to remain independent. That decision, while risky, underscored a consistent theme: absolute control over its narrative. To some, it was hubris. To others, it was integrity. Either way, it was strategic isolation at a moment when collaboration could have offered relief. Today, as the stock hovers near $1.12, the technical map is finely balanced. Support rests around resistance around 1/16. A break above the 50-day moving average could target 1.31, the 200-day level that defines structural reversal. Short-term traders can watch that range for breakout momentum. Medium-term investors may consider accumulation around $1, ahead of the next Remain-1 data release, expected in early 2026, with an intermediate target near 2.20. Long-term participants face binary outcomes. Success in pivotal trials or Rejuva's IND clearance could revalue the stock towards $6 to $7. Failure could retrace it to 0.80. The asymmetry is both the attraction and the danger. Over 15 years, Fractyl Health has lived through every stage of the biotech life cycle: conception, conviction, collapse, and cautious renewal. What makes this story resonate with investors isn't just its science, it's the defiance behind it. In a pharmaceutical world built on dependency, Fractyl's proposition of metabolic self-sufficiency feels almost rebellious. It challenges the notion that chronic disease must always mean chronic treatment. And that challenge, scientific, philosophical, and financial, is what keeps this $1 ticker relevant long after logic says it shouldn't be. As 2026 approaches, the stakes could not be clearer. The science is valid, the data are building, and the cash clock is ticking. Fractyl stands between extinction and vindication. If Revita's results hold and Rejuva progresses, guts could become the blueprint for a new metabolic era. If not, it will serve as a cautionary monument to ambition untempered by capital discipline. Either outcome will make it a case study in how narrative power can both create and destroy value on the public markets. Because in the end, this stock isn't just a story about biotechnology, it's a story about belief itself and what happens when conviction refuses to die. And for those who made it this far, thank you for watching, subscribing, liking, commenting, and sharing this episode. Beyond this support drives every analysis we create, and we'll keep delivering deeper, sharper stories that earn your trust. This was ValueStir.